infrastructure, industry, investment models and infrastructure. Okay. Questions are there. We'll take up the questions. Don't worry. Agriculture questions have left out. Mains questions and industries. We'll discuss both together. Now, let me start with investment models. Right. What are the investment models we'll be discussing? We'll start with the FDI. Many of you have been asking what is FDI, how FDI will be allowed, what is automatic route, etc. Now we'll discuss. Listen carefully. Okay. FDI, FPI, SEZ, NIMZ, and PPP. All the long forms are there in respective slides. You don't worry. Listen. Now let's start. What is FDI? What is FPI? FDI is any investment that is done by a foreign company in creating assets in India. I'll repeat the statement. Right? FDI simply stands for any foreign company creating physical assets, creating assets in India, that is called as FDI. For example, listen to this very carefully. A foreign company will bring money into India and let's say set up a manufacturing facility. Set up a manufacturing facility. Can I call this as FDI? Please let me know. Can I call this as FDI? A foreign company will bring money and set up airline company in India. Set up an airline company in India, right? For example, Akasa, right? I hope you are reading newspapers. Akasa has completed 1 year now. In Akasa, foreign investment is there, right? What about Volkswagen company? Foreign investment is there, right? Apple company, if they invest in India, all of that is basically FDI. So whenever a foreign company, right, whenever a foreign company will bring investment in India, create assets like this is called as FDI. On the other side, if foreign investors, I repeat, if foreign investors will bring money in India, invest in stock market, invest in share market, that is called as foreign portfolio investment. Anybody has difficulty in understanding the difference here? Sir, what is the long form? Long form is given here. FDI stands for foreign direct investment, FPI stands for foreign portfolio investment. FDI, please understand, they will invest and create assets in India, roads, manufacturing facilities, aeroplanes, etc. That is FDI. Whereas FPI, they will invest in shares, they will invest in bonds, etc. So can I call FDI will create physical assets, whereas FPI will create financial assets? Let me know. FDI will invest in physical assets. FPI will invest in financial assets, shares, bonds. These are financial assets. FDI will enter into a country to stay for a longer duration. They will not come today. They will not go tomorrow. They will enter into India for longer duration. 10 years, 15 years, 20 years, 25 years. As long as they can earn profit, they will remain in India. Whereas FPI, comparatively very short duration. The foreign investments can come under FPI today and they can take it out next week itself. They can take it out next month itself. They can take it out after 2 months. So FPI will invest in a country for a very shorter duration, comparatively very short duration. That is the reason FPI is also referred to as hot money. Please remember, that is the reason why FPI is also referred to as hot money. They'll keep on moving from one country to another country. Hot money. Right? So it is associated with multiplier effect. FDI is associated with multiplier effect. Whereas FPI will basically increase the amount of money that is available in the market. How much money is there in the bond market? It will increase. How much money is there in the stock market? It will increase. That's the role of FPI. Investments are done in order to earn profit. Investments are speculative in nature. They want to purchase the shares at a lower price. They want to sell it at higher price. Again, please understand, speculation means movement of market. They also want to earn profit. Many of you simply say, sir, FPS, they don't want to earn profit. Of course, yes, they also want to earn profit. But can I simply say they are betting their profit? They are basically betting on market behavior. They will purchase it at a lower price. They will sell it at a higher price. Yes or no? Or in case of Hindenburg, right? Have you heard of company Hindenburg? They want to purchase it at a higher price. They want to sell it at a lower price. So I hope you understand the argument. Speculation. Speculation means how the market behaves. They want to bet on the speculative behavior of the market. Right? So it is very difficult to attract FDI. Comparatively very easy to attract FPI. Right? FPI can come into India at any point of time. They can move out of India at any point of time. Whereas FDI, imagine you're a foreign investor. Look at current affairs example, you will understand. You're a foreign investor. In order to attract you, government has to reduce corporate taxes. Government has to change labor laws. Government has to make it easier for you to acquire land, etc., etc. So don't you think FDI, it is very difficult to attract FDI compared to FPI? Right? That is a basic difference. Please remember the differences between both FDI and FPI. Now, there is a committee recommendation. Please remember Arvind Mayuram committee. Okay, Arvind Mayuram committee. Whenever a foreign company will invest in purchasing equity in a company, that is, if it is a listed company, if the foreign company will purchase up to 10%, up to means what? Less than 10%, then we'll classify this as a FPI. And if the foreign company will invest in a listed company and purchase a 10% or more than 10%, we'll call this as EFTI. All of you okay with this definition? Please do let me know. Let me know, right? I'll repeat it again. Arvind Mayuram committee has given a very clear distinction between what is FDI, what is FPI. Because please understand, there could be certain concerns regarding the distinction. Because the regulations for both FDI are different. Regulations for FPI are different. You'll understand in some time. Have patience. Have patience. Okay. Many of say, sir, what is FII, etc. My dear, have patience. We'll compare all of that. Have patience. So in a listed company, if a foreign company will bring money and purchase less than 10%, we'll classify this as FPI. If it is a 10% or more than 10%, we'll classify this as FDI. Whereas in case of unlisted company, any amount of investment in equity will simply classify this as FDI. Now, some of you, as expected, some of you, right, have started typing, why not FPI in case of unlisted company? My dear, please tell me, point number one, where does FPI invest? In the stock market. And if I say it is an unlisted company, are the shares of this company available in the stock market? Think of it and do let me know. Many of you are asking, sir, why not FPI classification unlisted? Unlisted means these shares are not available in the stock market. Hence, FPIs cannot invest in the stock market in unlisted company. That is the reason any investment in unlisted company by a foreign company will be classified as FDI. Remember the definition, UPSC can ask you this definition. Now, let me enter into the details. We'll take up FDI separately, FPI separately. Point number one. What is the definition of FDI? Investment done by a foreign company in purchasing or creating physical assets in companies in India. Right? We'll talk from the context of India. They will create assets or they will enter into ownership. Sir, what do you mean by this? Let me give you simple examples. Listen to me very carefully. Imagine a foreign company will come to India, set up a company which is 100% owned by a foreign company. Let me know. Imagine a foreign company will come into India and they will set up their own company, 100% owned. That is one possibility. Second, they will set up a company, they'll simply set up an office in India, and whatever expenditures required, all the expenditures will be provided by a foreign company. I'll repeat the examples. Listen to me very carefully. First one, they will come to India, set up a company, create a new company in India. Create a new company. 100% of the company is owned by a foreign company. Second one, they'll come to India. Rather than setting up a new company, they'll simply open an office in India. Is it okay? They'll simply open an office. Whatever money is required to operate office will be provided by the foreign company. Third, they'll come to India and enter into a joint venture with Indian company. They'll enter into a joint venture. Joint venture means what? Some of the ownership will be with Indian company, remaining with a foreign company. Let's say 26% with Indian company, 74% with foreign company, or 26% with foreign company, remaining with Indian company. Or what about 49%? 49% will be owned by foreign company, 51% by Indian company, or vice versa. Can I say all these are basically the forms of FDI investment in India? Let me know. Can I say all these are basically the forms of FDI investments in India? That is, foreign companies are investing in India. That's it. Now, how they are allowed to come into India? How they are allowed to come into India? Are there any restrictions? Are there any conditions? Remember, there are two ways FDI can come into India. Two ways. One is called as a direct route or automatic route. Second one is called as approval route or government route. What is the basic idea? Point number one, please remember this carefully. FDI, whether it is allowed in the sector or not allowed, it is decided by Government of India. Very simple. FDI, whether it is allowed or not allowed, who will decide it? Government of India. Point number two, if it is allowed, how much is allowed? Whether 49% is allowed, 26% is allowed, 100% is allowed. To how much percentage it is allowed, government will decide it again. Point number three, government under security reasons. I repeat it, government under security reasons can also have specific type of a FDI restriction. For example, right now, please remember this. Right now, Government of India says any FDI that will flow from India's neighboring countries. I repeat, any investment that will flow from India's neighboring countries, it has to go through government route only. I'll repeat the statement. Please listen to me carefully. Any investment that is coming from India's neighboring countries, it has to go through government route only. Now, question is, what do you mean by government route? Simple. Government route means before you invest in India, you will have to take the permission from the government. You will have to take approval from the government. For example, imagine a Chinese company. All of you will agree when I say China is India's neighboring country. Anybody says no, China is not India's neighboring country, please do let me know. If a Chinese company wants to invest in India, whether they are investing in sector A, B, C, D, doesn't matter. They will have to go to the government, apply for approval from the government, and the government will give the approval. Then they will be allowed to invest in India. But on the other side, imagine government will say this sector automatic route is allowed. This sector, right, the approvals are not required. What do you mean by this? If a particular sector, it is under the automatic route, it simply means you do not take any approvals. You do not require any kind of approvals. You can directly bring the money in India and invest in India. But the condition is very simple here. Once you bring in the investment and you invest, after 30 days or in the next 30 days, you will have to give the information to RBI. You will have to tell RBI how many dollars you have brought in India and you have invested in India. So one is called as a direct route. No approvals are required. Simply invest in the sector. And second one is approval route. You will have to take the permission of the government. Now, under the approval route, again there are two, right? One is up to 5,000 crore rupees, up to 5,000 crore, and above 5,000 crore rupees. Now, if you are investing up to 5,000 crore rupees, your FDI investment is up to 5,000 crore, there is a mechanism that has been set for you, Foreign Investment Facilitation Portal, FIFP, Foreign Investment Facilitation Portal. All the ministries are part of this portal. You will have to apply for licensing approval on the portal. If your investment is up to 5,000 crore and if your investment is above 5,000 crore, then the approvals will be issued by Cabinet Committee on Economic Affairs. By Cabinet Committee on Economic Affairs. Done? All of you okay with direct route and approval route? Sir, any example of a direct route? Civil aviation. Civil aviation is a direct route, and any country, neighboring country, any investment that comes from the neighboring country, it is approval route. Where is FDI allowed? These are some of the sectors. These are some of the sectors where FDI is prohibited, right? Because understand this, based on national security, based on right, let's say the data privacy, based on whether these are dealing with the people's money, right? Some of the sectors we do not allow FDI. Now, do not worry about all of this. Simply remember the examples. Don't enter into why gaming it is not allowed, why that is allowed, why this is not allowed, etc., etc. Don't worry about it. Simple logical argument. Done. Right, so this is a direct route and this is approval route. Now, what are the advantages of FDI? What are the benefits? Point number one, whenever FDI will flow into India, you'll be able to attract a lot of investment. That is okay with all of you? You will be able to attract a lot of investment. Point number two is it will bring lot of resources. It will bring lot of resources, right? Managerial resources, financial resources, technological resources into India. It will promote competition in India. I'll give a very simple example. Tell me whether it makes sense to you or not. Flipkart versus Amazon. Of course, please understand. Today, Flipkart is also FDI only. Today, Flipkart is owned by foreign company. But earlier, Flipkart versus Amazon, or else another example, Uber versus Ola. Please tell me, is the second point okay with all of you? Look at the examples and do let me know. Right? FDI will promote competition. All of you okay with this? Third one, it will improve the balance of trade. Let me take the example of Apple. Apple has invested in India. It is manufacturing mobile phones in India, which means rather than importing these mobile phones, we are producing and we are exporting these mobile phones. Is it improving balance of trade or not? Is it improving balance of trade or not? Of course, yes. Next one, it will generate a lot of employment opportunities, and that's a fact. Companies coming in India will create a lot of jobs. And right, the fifth one is it will increase the market size of India, and it will lead to integration of Indian market with the global market. So please do let me know, all of you are okay with the merits of FDI? Let me know. Again, nothing is new in this. Nothing is new, right? Everything is whatever we have discussed earlier. Anybody has a problem? Please do let me know. Anybody has a problem? Can I go forward here? Can I go forward? Okay, thanks. What are the concerns? What are the demerits? What are the demerits? Government has to change their policies in order to attract the FDI. Right, sir, how can this be a demerit? I'll give a very simple current affairs example. 10 days ago, I'd asked you to read that article. In fact, I'd given you that article as well. Government, in order to attract the FDI, has reduced corporate tax rate. Has it affected Government of India's tax revenues? Let me know. Has it affected Government of India's tax revenues? Can I call it as a demerit? Can I call it as a demerit? Right, because government has to change their policies in order to attract foreign investors. Hence, it might affect government revenues. Second, may promote unhealthy competition. Sir, what do you mean by unhealthy competition? In case of the companies such as Amazon, there is an allegation. What is allegation? Amazon company sells the product at a very high discounts, which is called as a deep discount. Correct? It sells the products at a very, very high discounts, which is called as a deep discounting. Now, do you think this bottle sold by Amazon, the bottle sold by traditional shops. Do you think the traditional shops will be able to compete with Amazon? Think of it. Do you think the traditional shops will be able to compete with Amazon? No, they are not able to compete. So can I say on one side, there can be competition between Flipkart and Amazon, but on the other side, because of these types of companies, the traditional shops are incurring losses. Traditional shops are closing down because they are not able to compete. So may promote unhealthy competition. Third one, may lead to regional disparities. In case of India, please remember this. FDI we are attracting, but FDI is not entering into all the states. They are preferring some of the states. They prefer states such as Gujarat, Maharashtra, states such as right Karnataka, Tamil Nadu. Why? These are already having lot of infrastructure. Very simple. These states already have very good infrastructure. Right? Government promotes ease of doing business. So as a result of this, a lot of FDI that is flowing into India enters into these states. Now tell me, if a lot of FDI will enter into these states, don't you think the states inequality, regional inequality which is already present, will it become more wider or not? The regional disparities will further start increasing. Right? And finally, the companies might be involved in tax avoidance, tax evasion by using transfer pricing methodology, and that will further affect the revenues of government of India. Right? So these are some of the concerns or the demerits regarding foreign direct investment. All of you okay with this? All of you okay? Sir, where have we discussed transfer pricing? My dear, please open taxation chapter. Please open the taxation chapter. Companies are involved in tax evasion as well as a tax avoidance. That will affect the earnings of the government of India. Okay. Next, can we go forward? Sir, one thing not understood, FDI decreases trade deficit, then how it will promote it? My dear, listen, no, listen carefully. If if the trade balance is improved, doesn't mean that domestic market traditional shops will be benefited. If I'm running a shop where I'm selling this bottle, I will not be able to give you a discount given by Amazon company. And if I don't give you discount, you will not purchase it from me. So my revenues will go down. I will have to shut down my shop. So both the concepts are different. You are bringing unnecessarily two different concepts and merging them. Now, what are the other important points regarding FDI? India is one of the country with huge inflow of FDI. We receive lot of FDI. Generally, we are topped. We are in the top 10 countries in terms of receiving FDI. Post 2000, the services sector has attracted largest FDI in India. Which countries contribute to a very great extent to inflow of FDI in India? USA, Singapore, Mauritius. From these countries, we attract a lot of foreign direct investment. Okay. Now, another very important concept, depository receipt. This is there in the newspapers now. Listen to me very carefully. Another very important concept I want to discuss is the idea of a depository receipt. Now, what is a depository receipt? Let me explain to you. Please listen to me very carefully. Listen to me very carefully. Right? Imagine foreign company, let's say a company such as a Tesla wants to get listed in India. By the way, all of you know that Tesla is not listed in India. Correct? All of you know that, right? Tesla company is not listed in India. Right? Apple is not listed in India. So imagine they want to list their company in India. How they can do that? There is a concept called as a depository receipt. There is an idea called as a depository receipt. What happens in a depository receipt? Let's say, right? Let's say I'm sitting in USA. You are in India. I'm sitting in USA. Tesla company. I will take the shares of Tesla company, approach a bank, financial institutions, bank. These are called as custodian banks. Listen to me very carefully. I will take the shares of Tesla company, approach a custodian bank in USA, and I will deposit these Tesla shares to the custodian bank. Let's start. Right, this is USA, this is India. So Tesla company will approach a custodian bank here, will submit shares of Tesla company. Now this bank has an agreement with another custodian bank in India. Now this custodian bank, which is there in India, will issue depository receipts in the name of Tesla company in India. I will repeat the process here. Listen to me carefully. Stop typing. Listen first. I'm Tesla company. I want to list my securities in Indian market. How is that possible? I will take the shares of Tesla company. Tesla is already listed in USA. I will take the shares, approach a custodian institute here, deposit the shares. Now this custodian institute has an agreement with another custodian bank in India. Now this custodian bank will issue depository receipts of Tesla shares. Now imagine you will purchase these deposit receipts of a Tesla company. Is it as good as investing in listed shares of Tesla company? Let me know. Is it as good as investing in a Tesla shares of this company? All of you okay? And can I also say, think of it, can I also say the depository receipts represents, right, basically the listed shares or publicly traded shares of Tesla company. Let me know. The depository receipts also represent the publicly traded shares of Tesla company. All of you are okay with this process? All of you okay with this process? Sir, what is a custodian bank? My dear, anybody who will keep the custody of your shares are called as custodian banks. Have you heard of the term custodian or not? Let me know. Have you heard of the term custodian? Custodian is anybody who is your guardian. Right? For example, when your kids, right, when somebody has to sign documents related to you, they'll say custodian. Custodian means anybody who is holding them. Right? Anybody who is taking care of it, guarding them, that is called as custodian. Right? So I hope you understand the concept here. Concept is very simple. Right? USA, which is already listed, it is already listed. They want to issue the shares, right? They want to get listed in India. So this is the process they will follow. Right? And these instruments which are issued in India, these are called as depository receipt. Can we do the vice versa now? Can we do the vice versa? For example, Infosys. Imagine this is India and this is USA. Imagine Infosys. So Infosys will take the shares of Infosys company, approach a custodian institute in India, approach a custodian, submit the shares. Now this custodian has an agreement with another custodian in USA. They will list depository receipts, DRs of Infosys company in USA. Is the logic okay? So can Indian company get listed through depository receipts in USA? Yes. Can a foreign company get listed in India through depository receipts? Yes. This is basically the concept of depository receipts. And please remember this carefully. Please remember, depository receipts are considered to be part of FDI. Because you are issuing shares, you are selling ownership, collecting money. RBI says depository receipts are part of FDI, foreign direct investment. Now let me add one more very important point here. Right? The idea of a ADR, GDR and IDR. Now, example 1. Please look at it and tell me. Example 1. Where are the depository receipts listed? Please look at example 1 and tell me, where are the depository receipts listed? Can I say, Arey Baba, some of you are not reading correctly. Example 1, where are the depository receipts listed? These are listed in India or not? Please read. Right, my handwriting is not that bad also that you can't read. My handwriting is legible. You can read it. So can I say depository receipts are listed in India? So when these are listed in India, these are called as Indian depository receipts. All of you okay with why these are called as Indian depository receipt? Please do let me know right now. Where are they listed? Where are they listed? These are listed in India, hence called as Indian depository receipt. Look at second example. Example 2. Look at second example. Where are the depository receipts listed in second example? Where are the depository receipts listed in second example? This is right, USA. Can I call this as American depository receipts? All of you okay with this? Can I call this as American depository receipt? Any problem? So think of it. One is called as IDR. Whenever DRs are issued in Indian market, these are called as IDR. Second one is ADR, American deposit receipts. Whenever DRs are listed, issued in USA, these are called as ADRs. Third one is GDR, Global Depository Receipts. In case of Global Deposit Receipts, these are issued in other markets. For example, think of it. Indian company will issue deposit receipt in European market. Is it ADR? I'll repeat the example here. Indian company will issue the depository receipts in European market. Can I call this as ADR? No. Can I call this as IDR? No. Right? What is the name? Global Depository Receipts. Global Depository Receipts. Right? So there are three types of receipts here. Please remember. And deposit receipts are generally referred to as a part of FDI only, foreign direct investment. Okay, done. Can I go forward now? Can I go forward? So these are certain very important points regarding concept of FDI, foreign direct investment. Please be very, very careful. Now next one is FPI, foreign portfolio investments. Next one is FPI, foreign portfolio investments. Now what is foreign portfolio investments? Let's try and understand. So FPI simply means what? Any foreign investor. Now let me use one more term, right? And let me know if there is any difficulty. Can I say FPI can be any non-resident investor who will invest in financial instruments in India? I'll repeat the statement. Again. What is FPI? Any non-resident investor who will invest in financial instruments in India. Non-resident means what? Anybody who is residing outside India, not an Indian, outside India. Any non-resident Indian investor, right, who will be investing in India will be referred to as, again, in financial instruments. So these are called as FPIs. Now, many of you kept on asking me, then what is FPI? What is FPI? What is FPI? Or what is FII? In fact, we have discussed all of it. Right? Please do let me know. Right? Go back to earlier discussion. Can we say there are different types of non-resident investors in India? For example, what if an individual will invest in India? Is it allowed? Of course, yes. Right? An individual investor, of course, yes, they are allowed to invest in India. Just like you are allowed to invest in USA market, they are also allowed to invest in India. What about a financial institution such as a mutual fund company, insurance company, etc., etc.? They are also allowed to invest in India. So institutions are different, individuals are different. So now look at it and say, can I say, think of it, can I say FII is a part of FPI? Let me know. Can I say FII are part of FPI? Anybody has a problem? Sir, you have not discussed it. Please don't tell me that. Please don't tell me that I have not discussed. I'll tell you the context also. I gave you examples. I wrote also. Where? Open the financial market. Open the PPT on financial market. There's a concept of P note. Open that P note, right? Then have a look at it. Then have a look at it. You will realize. I gave you example of individuals. I gave you example of insurance company, mutual fund company. I said these are institutions. I can call them as foreign institutional investor. Whereas individuals such as you and me, we cannot be called as institutions. We will be retail investors. So category 1 as well as category 2. This is a classification. Please remember it. Now, in what way? In what way investment can come into India? One way is through FIIs, foreign institutional investments. Second one is fully accessible route. And the third one is voluntary retention route, FAR and VRR. The second and third are part of current affairs. Understand this very, very carefully. Both are part of current affairs. Very recently introduced by RBI, promoted by RBI. Listen to me very carefully now. Point number 1. Do you remember the concept of capital account under balance of payment? Can I say, because there is a concern of volatility that could be created by foreign investors in India, we have partial capital account convertibility. Yes, we have partial capital account convertibility. Current account is fully convertible. Capital account is partially convertible. That's a reason. Second, now think of it. You are the RBI governor. Your concern is that I'm a foreign investor. I will enter into India and run out of India very quickly. And that might lead to volatility in Indian market. But what if, I repeat, what if I voluntarily come to you and say that I will invest in India for 5 years? Please think of it. I will voluntarily come to you and I will promise you, I will guarantee that I will invest in India for 5 years. Don't you think whatever restrictions are commonly applicable for all the foreign investors, those restrictions should not be applicable to me? I'll repeat it again. I'll repeat it. Please understand the logic behind it. Your RBI, you're concerned that foreign investors will come into India today and they will withdraw the money tomorrow. And because of this behavior of the foreign investors, lot of volatility can be created in India. But what I'm saying is, I will come to you and I'm guaranteeing that I will keep my investments for 5 years in India. Before 5 years, I'll say, I will not withdraw all my investments. I'll keep certain investments in India. So don't you think certain relaxation should be provided to me? Don't you think certain exemption should be provided to me? Because I'm not looking for short-term investment. I'm looking for long-term investment. That is the precise reason. Now there are two very important tools used, promoted by RBI. One is called as voluntary retention route. Second one is called as fully accessible route. Let me start with voluntary retention route. There is a limit on investment or how much FPI can flow into the debt market. There is a limit how much FPI can flow into debt market because withdrawal can create volatility. Now these limits to a certain extent will be relaxed. These limits will be removed on those foreign investors who are voluntarily guaranteeing to RBI that at least 75% of their investment will remain in India for at least 3 years. I'll repeat the statement here. Understand the statement. These kind of restrictions which are uniformly applicable to all the foreign investors in the debt market, these will be relaxed. These will be withdrawn only for those investors who will voluntarily guarantee to RBI that at least 75% of their investment will remain in India for at least 3 years. This route is called as voluntary retention route. And under this RBI, please remember this, under this RBI will give more preference to the investors who wish to invest for a longer duration in India. For example, think of it. You are the RBI governor. Two investors will come to you. One investor will say they will hold 3/4 of their investment for 4 years in India. First investor says they will hold 3/4 of their investment for 4 years in India. And second investor says that they will hold 3/4 of their investment for 7 years in India. As an RBI governor, should you provide more preference for the first investor or the second investor? Don't you think if the second investor guarantees longer duration, you will give more preference for the second investor? So all of you are okay with this? All of you are okay? This route is called as a voluntary retention route. We attract through voluntary retention route long-term investors, not short-term. Not those will come today and run out tomorrow. Long-term investors who wish to invest in the corporate bond market as well as government bond market. This route is called as voluntary retention route. Done. This is called as a VRR. Next one is EFAR, fully accessible route. Now same logic, apply the same logic, but please understand this carefully now. Under VRR, we attract in corporate bond market as well as government bond market. Whereas in case of FAR, fully accessible route, are simply say only in certain government bonds. I repeat, only in certain government bonds, I want to attract long-term investors. Right? I want to attract long-term investors. What kind of government bonds? You want to attract long-term investments in 5-year government bonds. You want to attract long-term investments in 10-year government bonds. You want to attract long-term investments from the foreign market in 30-year government bonds. So Reserve Bank of India says those investors who want to invest for a longer duration in government bonds of 5-year tenure, 10-year tenure, 30-year tenure government bonds, I will relax some of the restrictions on these foreign investors, but they will be allowed to invest only in these government bonds. Done. So there is a limit on investment for FPIs in the debt market. In case of FAR, these kind of restrictions, when these foreign investors will invest on specified government securities, these restrictions will be withdrawn. These restrictions would be removed. Right? And what kind of government bonds are covered under fully accessible route? 5-year government bond, 10-year government bond, and 30-year government bonds. Done. So this is called as fully accessible route. Anybody has any kind of difficulty? Please do let me know. Anybody has any kind of difficulty to understand the difference between VAR and FAR? VAR can be corporate as well as government, whereas FAR specifically targeting certain types of government securities. And that is a basic difference between VAR and SAR. This is FDI and FPI. Okay. What is point 2? Arey Baba. Some of the restrictions which are there, these restrictions will be withdrawn. Right? Because there are restrictions, these will be withdrawn. Okay. That is a basic idea. Okay. Means in VRR and FAR, treasury bill investments. No, treasury bills are short term. Treasury bills are short term. These are not attracted in treasury bills. These are attractive for government bonds. So can DRs be called as IPO? My dear DRs, the company is already listed. Company is already listed. Why will you call this as an IPO? Company is already listed. Tesla is already listed. Infosys is already listed. Okay. Okay, done. What is Tobin tax? Tobin tax was a proposal, right? Basically, Tobin tax means on these foreign investment which will go quickly. They will come into India quickly. They will go out of India quickly. They will create volatility. To cut the volatility, to reduce the volatility, a tax proposal was given, and that tax is called as a Tobin tax. Okay. Next, concept of special economic zones. SEZ, concept of special economic zones. Now, what is a special economic zone? Right, we have discussed the idea earlier. Let's have a detailed look at it. Special economic zones are those areas in which business and trade laws are different from rest of the country. What do you mean by this? I'll give a very simple example. Please listen to me very carefully now. Imagine this is India, and this region has been identified as a special economic zone. Imagine government of India has declared this corner as special economic zone. So rest of India will be called as a domestic tariff area. All of you remember this? Rest of India is called as a domestic tariff area, DTA. Now, what is the argument of SEZ? If you set up any unit in the SEZ, government of India will give you tax exemption. I'll repeat it. If you set up, let's say, a manufacturing unit in the SEZ, on this manufacturing, whatever profits you earn for 5 years, tax exemption is provided. Tax exemption, 100% tax exemption. And next 5 years, 50% tax exemption. And if you import anything, I repeat, if you import anything to manufacture this bottle, on the import, government will not impose any tariff. On the import, government will not impose any taxes. So now, please have a look at the first point regarding SEZ and tell me, does it make sense to you? Please look at the first point and tell me, does it make sense to you? SEZ is an area in which the business and trade laws are different from rest of the country. Right? Laws are applied differently. Why? Many of you will ask me, sir, why? Why is that so? Reason is that government of India will promote SEZs in order to promote exports. Right? The idea is it is to promote more and more exports. In order to make exports more competitive, government will say, whatever you are going to import, on that I will not impose taxes, so that you can export more and more. Point number 3. Sir, what if I manufacture within SEZ, but rather than exporting, I will sell it in the domestic tariff area? Then what will happen? Please look at it. If you are manufacturing this bottle in the SEZ, right, by importing certain raw material, do you have an advantage over other domestic manufacturers? I'll repeat the statement here. Right? For the manufacture of bottle, raw material is required. I'm outside SEZ. You are inside SEZ. Both of us will import raw material. I will pay taxes. You will not pay taxes. So, are you not having an advantage over me? Because you are not paying taxes. That is the precise reason. Whenever you manufacture anything within SEZ, rather than exporting, if you sell it in the domestic market, government will treat this bottle as an import. Government will treat this bottle as an import, and the government will impose taxes accordingly. Right? So whatever is produced, it is for export purposes. But rather than exporting, if you sell it in the domestic tariff area, it will be treated as an import. Government will impose taxes on it. So it is a duty-free territory outside the customs territory. Tax exemption, 100% tax exemption for first 5 years, 50% tax exemption in the next 5 years. The output in the SEZ, it is for export purposes. But if you want to sell it in the domestic tariff area, government will treat it as an import and impose taxes accordingly. And have a look at this. No import duty on any of the imported goods, but there is a condition. What is the condition? You will have to be a net foreign exchange earner. You will have to be a net foreign exchange earner. What do you mean by net foreign exchange earner? Imagine you will import a raw material to produce it. Can I say because of this, $10 are going out of India? There is an outflow of $10. Now what government says is, right, whatever you import, as a result of this, right, the dollars are going out of India. Now the earnings from your exports should be more than whatever dollars have gone out of India because of your import. Whatever imports you have done, dollars have gone out. Now you, by exporting, you will have to earn dollars. For example, dollars have gone outside. Now your earnings, that is inflow of dollars, should be greater than $10. Can I say, by exporting, imagine you have earned $20. Can I say you are a net foreign exchange earner of $10? Let me know. In this example, can I say You are a net foreign exchange earner of $10. That is a condition. That is a condition. You will have to be a net foreign exchange earner. Now, apart from this, who will develop the special economic zones? Government will provide the approvals, but it is the private sector participants who will develop SEZs. Government will provide the approval, but government doesn't develop SEZs. It is a private sector which will develop and operate SEZs. The act provides for a single window clearance mechanism. That is, only one authority is present. You want to develop an SEZ, you will have to take multiple licenses. You will have to take multiple approvals. You don't have to run from one ministry to another ministry. Only one authority is there. That authority, board of approval, will give you all the approvals required. Single window clearance mechanism. Right? So these are certain very important features of special economic zones. Now, how many SEZs are working in case of India? There are more than 400 SEZs which have been approved by the government. All of them are not operating. Around 267 are actually operating in India. Right? So more than 400 have been approved. More than 200 are operating in India. Point number 2. The whole idea of SEZ was to promote exports. So what has been the performance of SEZs in terms of exports? Please have a look at it. Back in the year 2005, right, sir, why only 2005? Please remember, government introduced SEZ Act of 2005. By introducing and getting